Hello everyone, welcome back. In this particular video, I want everyone to understand how to screen companies, how to go from an idea to execution of what companies to study, and also quickly go over what I would look for in those same companies. So when you're creating a screener, it's not just about you add some random things and then hit enter and randomly start going over them. No, it's not that way, right? So I want to discuss the philosophy of how to create a screener and the practice of it. And I firmly believe that to the person that is willing to work hard, education should come for free. Education should not be beyond paid memberships of 15,000 rupees a year or 30,000 rupees a year. And that is one of the primary reasons that I make these videos. So if you do find them useful, I would urge you to subscribe and also like the video if you think that I'm adding value to your life. So we are on Screener. I think Screener premium subscription is probably the only thing I would say an investor definitely needs. Everything else, including things like Tajori, I would consider to be optional, but you cannot do without Screener. They add that much value to your life. And I think that 499 or whatever is the price is just worth it, every rupee, right? So let's go to create new screen, because we want to start from the scratch. So the first thing to remember when you're creating screens is that screens are a language for you to communicate with a database what you want, right? The first step always has to be for you to understand what you want, right? So imagine that I'm looking for companies which have some kind of non-linear profit growth, right? Typically, this would happen because of multiple reasons. It could be product mix change, it could be operating leverage, and so on and so forth, right? What we mean by non-linear growth is that the top line grows at maybe say 15%, but the bottom line actually grows at something like 35%, right? That is non-linear profit growth. So let's try to codify that. Sales growth in 3 years greater than 15. What that means is last 3-year CAGR sales growth, compounded average growth rate, is 15%, and the sales growth in 5 years is also 15%. So I'm taking 3 and 5 because I think 1 year is like too less time to really judge what a company is doing fundamentals wise, especially if you're like analyzing and evaluating a company for investment. Now the thing is, this is the sales growth. The profit growth should ideally be much more. So I'm putting 35, which is like more than double of 15, right? And similarly, the profit growth in 5 years should also be more than 35. Now, one thing that you have to remember is, at least it is my firm belief, and you can do some mathematics to convince yourself that unless the company has a high ROE, return on equity, it is not going to create value, right? It is actually destroying value. Growth destroys value if ROE is less than cost of capital. So this is why I would always want to put some kind of a ROE filter, unless of course I want companies which are turnarounds and things like that. I'm not looking for turnarounds here. I'm looking for companies which are already executing well, right? Now the other thing to remember is, typically, I think if you think of screener as a way to direct your attention, it makes most sense to start with companies which are undervalued, because that is where the highest alpha is, right? The highest alpha is obviously not in companies which are overvalued. So I also want price to earnings to be less than 20, right? So sales growth in 3 years should be more than 15, 5 years also more than 15. Profit growth should be more than 35, return on equity should be 15, and price to earnings should be less than 20. And let's put a market cap condition also. I want market capitalization to be at least say 100 crore, because below this even I would feel a bit hesitant to look at it. But I mean, of course, it depends on the particular person. Non-linear profit growth, companies growing profits much faster than sales. could be due to product mix or operating leverage, financial deleverage, etc. Financial deleverage meaning if you're paying back debt, that would reduce your interest cost and that can also boost your earnings, of course. Of course, I want to make the query public. So now I save it. I want to get email updates on it. So now we have companies. What I want to do is I want to order them by market cap with the largest company on top. Because again, the point is, if you think of large companies, those are easier to study, right? So what I want to do in the remaining video is to go over some of these companies. You can see that there are 66 companies. We'll probably go over some of them. I don't know how many. Let's see, like uh, when do I feel like we've gone over enough companies, but we have sorted by market cap, right? So let's look at this. What is Aditya Birla Capital? Now this is I'm sharing with you exactly what I would have done, how I would have treated a screener, right? Rather than sorting by market cap, I might have sorted by, let's say, sales growth or ROC. That's another way to do it. But because I also want to be very responsible and not cover random very small companies, that's why I'm starting with market cap, sorting by market cap. Aditya Birla Capital, holding company for financial services of Aditya Birla Group, Universal Financial Solutions Group catering to diverse finance needs. Let's open the website. So one thing that you can immediately tell is I'm in love with screener, right? You really don't need to go anywhere. You just read this entire thing here. I think that is generally like good enough to know the core thesis of what the company is. I really don't want to spend more than 2 to 5 minutes per company. So as soon as I think I've spent enough, I'll just move on to the next one, basically. Maybe another thing to do is go to sheets and create like a shortlist kind of thing. Shortlist. I mean, let's say company and shortlisted. This is like shortlisted for deep dive. Like, do I want to dive deeper into it? You can see that, Aditya Birla Capital looks like mutual funds, life insurance, personal finance, life finance, lending, insurance, asset management. Life insurance is 51%, NBFC is 27% in FY21, housing finance little bit, asset management little bit. Mostly looks like life insurance and then maybe a little bit NBFC. I think we have gotten a good hang of it, to be honest. This is like your Aditya Birla life insurance schemes and mutual fund, the owner company for that. Okay, let's come down. I'm looking at the P&L to figure out why the profit growth was non-linear. It has indeed gone up from like 700 crore to 5,000 crore, very non-linear growth. Top line has gone up maybe less than 3x. I'm trying to understand why. This is very interesting. So it does look like the other income has played a big role here. So I guess one would have to go through the con calls to figure out what is this other income, and like maybe it's sometimes other income is actually operational income. If you look at the product segments, looks like most of the growth. Let's look at the profits. Whoa. Basically, most of the profit growth is coming from NBFC. Life insurance is not contributing that much to the profits, and asset management is contributing a lot but not growing that much. So essentially, it means it's mostly like a NBFC, and it would probably be valued like an NBFC also. And then you can see the huge profit from other financial services that has to be figured out. Right. Very interesting. Okay, I think we have spent a lot of time on this one. Uh, it definitely looks worth studying a bit more in depth, especially to figure out where the other income came from. So let's just put that out here and go to the next one. Jindal Stainless. Largest manufacturers of stainless steel flat products and so forth, consumer products. I think I know Jindal. The reason is recently I bought a house and there the entry gate is of Jindal stainless steel. So now I definitely have seen their product and like I have bought their product. Stainless steel plant in Jaipur, Odisha. Jajpur, Odisha. I guess the other good thing about the large companies is that since they are so large, they typically do presentation, so that also makes it very easy to quickly just screen over it. Now, at least when I look at it, it looks like their products go into rockets also, which is so interesting. But we should remember that steel is a commodity. Like commodities will go into everything. But let's look at it and figure out. Number one stainless steel producer in India. Number five top global producer ex China. So that's also showing you the scale of Jindal, right? Jindal Stainless. 3 metric ton per annum stainless steel capacity. Most is in Odisha and then some is in Hisar. Looks like stainless steel is probably growing the fastest among all the metals at a global level, and it's very corrosion resistance, of course. It shines very bright and like it's beautiful to look at. India stainless steel should probably also grow at like 7.5%, which makes sense in line with GDP. I was just checking that it's actually stainless steel. So it is indeed in the top few stainless steel producers in the world, which is good. Right. Largest one is Sinshan, which is like 9,000, and Jindal is at 3,000. However, they are measuring it. Most of the stainless steel goes in consumer durables in 1998, but now probably like only 44% goes in consumer durables, and then some of it goes in ABC and art. I guess we'll have to figure out what that is. Now, the fascinating thing is their EBITDA per ton, right? Look at the journey of EBITDA per ton. That itself shows you the reason probably for the non-linear growth. It's the fact that they're going more into value added. So it's probably a product mix kind of a journey, and that has resulted in EBITDA per ton rising. It's like flyovers, footover bridges, all kind of airport, railway station, all kind of constructions require stainless steel. Ethanol, hydrogen, very interesting. By the way, I'm also studying these businesses for the first time, studying or like screening. So I don't know anything more than the viewer who's watching the video. Yeah, things like being the first in the industry, fifth in the non-China, all of those are important. Those show the scale and the competitive advantage of the company. So which is I was focusing on that earlier. I guess it's very hard to figure out a lot more here, and go back to we would have to go back to um, reading the con calls to know more. But you can clearly see the EBITDA per ton journey from like 19,000 to like 27,000 because of the war and all kinds of inflationary pressures. But now it's coming back to like the pre-war era. So probably from here it can resume back its upward journey because of value addition. Of course, there can be multiple reasons for EBITDA per ton rising, including like non-sustainable reasons, and all of that we have to read the con call. So it does look interesting. I think these are both worth. So the reason what we would do in the deep dive, if we do it when we do it, is to look for if these reasons for non-linear profit growth can continue into the future or not. Is it possible that whatever has caused profit to compound at 35% in the last 3 and 5 years can continue to work, and thus the company can continue to compound profits at 35% in the next 3 or 5 years, right? That's basically what a deep dive would tell us. Anyway, let's go back to the next one. So Angel One is interesting. I am interested in Angel One. I have made threads on Angel One. I don't think we need to go much deeper into it. It's basically a broking company. It is gaining market share from all kinds of um, other brokers. Brokers have an inherent operating leverage because of the fact that once you've built the platform, the incremental cost of servicing is very low. In fact, they have pointed that out, that the biggest cost is actually the acquisition of the customer, right? If you think about it, the biggest cost you take in day one in acquiring the customer, after that it's just profits, right? And in fact, the contribution margins are like 90% in year 2, 3, and so forth. Let's see if I can find it. I think this is the one. Like the contribution margins 56% in year one because that's where the cost of acquisition is high. And after that, look at year two and year three, right? 92%, 92%, right? In year two and three. So I think it is a good business worth studying. Of course, I am biased because I am invested. So of course, it goes without saying, for everything that I ever say in the public domain, nothing I will ever say is a buy or sell recommendation. I am not a SEBI registered advisor. It is in everyone's best interest that they think deeply about the kind of businesses they want to own or how they want to compound their wealth, and not blindly follow anybody, because they could be playing a different game, right? The first step to investing is to know what game you are playing. Why are you in it? What are you looking for, right? The next one is Ujjivan Small Finance Bank. This is also a company that I am invested in through Ujjivan Financial Services. Again, the thesis here is it's the second largest small finance bank, second or I think maybe the third largest after AU and Equitas. And Ujjivan, I think 60% or so is MFI like. It's basically non-secured kind of lending, MFI individual lending, that kind of thing, and 40% is securitized or secured. Um, there is a decent turnaround that happened after COVID, where they have now started showing much better profits. I think that is also the reason for the non-linear growth, is that if you go back to the time, let's come to the P&L maybe, and that will make it easier. Okay, I think there is definitely a like one-off kind of thing happening here where like the tax rates were like too high maybe, and that could be one reason. Another thing, of course, is I think the financing margins were low in 2018 also. I think when the um, GST and demonetization happened, I think at that point also they had some losses. It was definitely the low base thing also coming in. So I think it's only now that their financing margins are at a decent level of like 22, 23%. So this does look a bit misleading, I would say. Definitely, it's coming into the screener by chance. It's not adhering to the actual things we are looking for in the screener. But nevertheless, it's an interesting company, and I think it's worth studying. Again, like everything else, there is no recommendation to buy or sell by any means. Let's go to the next one. So, by the way, one of the reasons I created this screener is um, when I looked at some of the companies I own, I realized that they have this underlying feature of non-linear profit growth. And then I thought, let's create a screener so that I am more, I'm covering all the companies that fit that pattern exhaustively. Let's go to Ujjivan. Okay, I think we studied Ujjivan, or we talked about it. Let's go to Archean Chemical Industries. So in fact, Archean, I had even uploaded the con call recently to YouTube because I couldn't find it, and I think it's an interesting company worth studying. From what I could figure out, it's more in the commoditized segment of chemicals right now. But what I really want to learn is why do they have such high operating margins and ROCEs despite being in a commoditized kind of segment? There do seem to be elements of competitive advantage or moat, primarily because they are very backward integrated. They own the mines from which they get the salt and the bromine that they then export. And importantly, they also have plans for forward integration, right? So I think it's definitely worth studying. Let's go to the PPT. I think that would be the fastest way. A leading manufacturer of specialty marine chemicals. Bromine is 40%, industrial salt is 59%. I do want to add that a lot of times companies can, overstate their position. A lot of investor communication is marketing or like how you present yourself. So we as investors have to be more discerning in figuring out which companies are really specialty and which are just claiming to be specialty, and value copper for copper and not copper as gold. Leadership position in Indian bromine merchant sales, 48% is exported. I think they just make bromine from what I could figure out at least until now. And industrial salt, I think from what I could figure out, they basically sort of process the brine in the they process the brine which is in the regions of Kutch in Gujarat, and there of course when you process the brine you get bromine and you get salt, so they probably sell both of those. That would be one reason why they have such high margins, because they are just like very integrated in that value space. Archean use brine from own reservoir, so they own that reservoir as raw material. So of course, I mean, if you think about it, their RM cost is like zero because they're not buying anything, right? They own the piece of land where they need to run some process to separate out the sludge or brine into bromine and salts. India is well placed with brine at the Great Run of Kutch, right? As I was saying, it's very close proximity to the Mundra port and the Jakhau port, um, Jakhau jetty. Yeah, definitely. I think it's interesting. The reason I'm also saying that is I don't think the valuations are that demanding right now, and I think it's worth studying at least, right? With the market correction, it could definitely come down to 12 times earnings, right? And it will become even more attractive. But at that point, uh, our homework has to be complete for us to take advantage. I want to figure out, now you can see that the gross margins are like crazy, right? That makes a lot of sense because they're not buying anything. Like they're literally taking salt from a land and evaporating it, right? Probably. That's what I could figure out. Yeah, let's go. I want to do this one a little bit more. So this is the one. See, access to reserves is the biggest one. From my understanding, the Kutch area is a protected kind of region. It would be difficult to get land there. That is the first and the most important kind of access is just the supply chain, right? Limited number of locations globally where it would be suitable to do this kind of work, right? You can't just do this kind of work everywhere, of course. It needs that right confluence of the right kind of climate, the right kind of environment where bromine and salt are present, actually. I guess they made a multi-year investment in brine field development. We have to read probably the con call and figure that out, like what was that investment and why did it take multiple years. Yeah, it definitely looks interesting. I think I want to go to the client thing also. I think major client they're saying is Vanhua, Unibrom, Tiani. Yeah, I don't know them. We'll have to like separately Google for it and figure out something about industry growth. This is the important one that I think in the con call we have to figure out because effectively what it means is they will become their own clients, right? You created bromine, now you have the scientific and technological setup to process it and create chemicals, right? And then rather than selling a commodity, you have now gone into selling somewhat more specialty kind of products. So of course, commodity to specialty is like a spectrum, right? And someone like Archean and their bromine might be very low on that spectrum. From 2, you can still come to 4 or 5. You would probably still be commodity, but less commoditized. I think it is definitely worth studying. And in fact, Archean is one of the companies that I was studying. That's why I had uploaded the con call also to my channel. Definitely looks interesting. They are doing some greenfield expansion of bromine derivatives. Like this is the one I was talking to you about, right? They are going into the vertical or downstream integration, becoming their own clients, right? High-end flame retardant, clear brine fluids, pure terephthalic acid synthesis. I think these are the ones that really we have to figure out, and they are investing a lot of money into this. Is like 250 crore is a decent amount of money to invest. I think let's look at their fixed assets and figure out how large that is for them. They have a fixed asset base of like 1100 crores, so 250 is like 25% or so of their fixed asset base, right? So I think it's worth studying and figuring out like what's going on here. They want to augment the capacity, they want to do greenfield expansion of bromine derivatives, probably to be commercialized by FY24. So the immediate thing that one should try to do is to figure out the revenue potential from these products. Look for environment clearances. This is something I had covered in the previous video, which is the art of becoming an Atmanirbhar investor, right? Environment clearance, Archean Chemical. Yep. This is Archean Chemicals. Sulfate of potash, bromine, production of bromine derivatives, right? This is the, I think this is the one that we are looking at. I mean, this is the one that we want. So what I typically do is I'll just open all the blue links I can see, which is like all the URLs. I think there's something to learn from like everything that they have uploaded. Okay, this is exactly what we wanted, right? There's a list of everything. So they will produce bromines. Now look at the capacity expansion, right? They're going from 12,000 at Bhuj to 67,000, right? Sulfate of potash from 1,000 to, I mean 1 lakh to 3 lakh. Green bromine, uh, no expansion. Epsomite, and then I think these are the bromine derivatives. These are the ones that we really have to figure out. Tetrabromobisphenol, bis dibromopropyl ether, decabromo diphenyl ether, hexabromobenzene, hydrobromic acid. They definitely look still on the lower side of the value addition, but that's how you climb a ladder, right? You cannot go from rung 2 to rung 8 directly. You cannot expect that they'll suddenly just start doing innovator synthesis for large molecules, right? That's not how it happens. So I would say they are like much behind something like a Newgen Chemicals in bromine. But that also means that the opportunity to grow, opportunity to go up the value curve is much higher for them, right? And these same products could be like a 25-30% margin product for Newgen. It could be a 65-70% margin product for Archean by the virtue of being their own raw material producer, right? You make your own raw material. I mean, we have to figure those things out, of course. They are literally making stuff out of thin air, right? The total capex they'll have to do is 1400 crores for all of this. I mean, the environment clearance they took. So clearly they have good plans. It's worth studying. In fact, if I had to like rank it among the shortlisted ones, I would say Jindal Stainless is probably 2, Archean is 1, and AB Capital is 3 among the ones we have already seen. Let's see more. Then this JK paper. So again, JK paper, I think I am a consumer. Let me quickly see if I can show you guys. I hope you can see this JK paper, right? I am a customer of JK paper. I think this would be easier to see. So yeah, I mean there are products all around us. I mean, what are the odds of that? We looked at the top few companies. I think I've used Aditya Birla's insurance. I have used Jindal Stainless's stainless steel door. I have used JK paper. I have probably used Archean's bromine medicines without even knowing about it. And I have obviously used Angel One's broking platform also, right? If you go back, probably used this, used this, used this. Ujjivan I have not used directly. Archean probably used it. JK also used it, right? That is the fascinating part of it. Anyway, so I mean, clearly, like you can see, like I mean, I just showed you their product, right? We know that they make papers. But the thing to remember about paper companies is paper is a true commodity, and that is why you will find that the PE ratios will always be very low. And to be honest, I've never had the motivation to study it because I'm always looking for entry barriers and figuring out like how do I find a company where I can ideally stay invested for 20 years. Whether I actually stay invested, many things have to go right. But when I'm buying it, the idea is to find companies where I can stay invested for 20 years. The optionality should be there. So paper, it didn't seem that way to me. Let's just quickly glance at its Um, I think this is also very interesting. You can see that the operating margins have actually expanded pretty dramatically from like 11% to 31%, right? That is the reason for the nonlinear growth. Why have they expanded? We don't know. We'll have to actually um, like look at the con call and annual report and figure that out. You can see that the gross margins have also expanded a fair amount. So from material cost being 58%, it's 44%, right? Meaning that almost 16% expansion, right? So 11 to 31, almost all of that is through the gross margin expansion, right? So probably they are moving more into value added, like this printable paper copy thing that I have, and that could be the reason that the gross margins have expanded. That also, unfortunately, what it means for us is it might be difficult to extrapolate this into the future, right? That from 31, can they now go to a place where they have they have like sorry, my throat is a bit bad. Can they go to a place where they have something like 30, I mean 50 to 60% operating margin? Very hard to imagine, like very, very hard to imagine, right? So this was a good one-time journey, and anybody who bought in 2012 is probably doing decently well, both in stock price and of course compounded profit growth. But might be difficult to replicate, and one might just get sales growth kind of growth here. Uh, a bit more probably if they can do some value addition. This is just initial thoughts, the prior for the Bayesian equation by reading about things. So I think this is done. Let's go to the next one. HG Infra. Indian Road Infrastructure Company engaged in EPC, right? So this is an EPC company. Now again, you would remember what I had said. Ki I am not very interested in reading about commoditized kind of industries. It just does not excite me that much, right? But let's at least see like why the profit could have grown non-linearly. Looks like there is definitely some margin expansion from like 15 to 20%. That could be one reason. Uh, Another thing I can see is that the depreciation has not gone up as much as the top line has, right? Top line has gone up maybe 5x to 4x. Depreciation from at least 2018, it has gone up maybe like it has doubled, right? So we have to see like have they changed the depreciation policy? Maybe they have become asset light. We'll have to see those things when we go to the con call. So I'm also trying to demonstrate through this how I would read a con call, right? I'm looking for changes here, making a mental note of questions I want to be answered, and then when I'm going through the con call or annual report, those are the specific things I'm going to look for, right? That did they like change something in terms of how they create or utilize fixed assets? Why did the operating margins go up? Maybe we should look at the expenses ones. Looks like the gross margins have also actually gone down. uh, Manufacturing margins, like we'll have to figure this one out, because I don't know why an EPC company should have manufacturing costs. Look at this, right? This is the reason I would multiple years of very negative operating cash flows, multiple years. It's not just 1 year, right? 1 year you can explain away, rationalize it. 2 years, and then even before that it was just 70. If you just add this up, this would all be negative. The cumulative cash flow from 2017 to 2023 would be negative. I can just look at the numbers and tell you that, right? Like 440 positive here, and then maybe this is like 150 or so, 200, so like minus 200 crore operating cash flow over 6 years, right? Definitely does not look like a good picture. So I mean, at least to me it's a clear avoid. JK paper, right? JK paper to me is also an avoid. It's just who I am as an investor, right? It does not mean I'm sure people can make money even in these companies. It just said I won't. Next is Ujjivan Financial Services, which we just talked about. That's just the holding company for Ujjivan Small Finance Bank. Then there's RCF. I've never seen this company. Archean Chemicals and Fertilizers. It is a PSU with, like, basically they make fertilizers, a PSU that makes fertilizers, right? Again, it has two things which I am trying to avoid. Fertilizer companies are an avoid because they are mostly the end customer does not have paying power. It's like government is the producer, government is the buyer. So it's like the government is taking money from one pocket and putting it into another, right? And then we are trying to give value to that, right? What value can we give to that? But probably should still see the P&L to see like what's happening there. Maybe there's like a very low base because of this year if we are looking at 5 year from here, and of course COVID would be a very low base also. That could be one reason that it's showing non-linear profit growth. um, yeah, but look at the margins, right? uh, Very thin margins. To me this is a clear avoid. Let's go to the next one, Fusion Microfinance. hmm Looks like they're an NBFC. uh, they're a NBFC MFI, microfinance institution. They have a decent ROE, I think 21% is decent if screener is accurate. Now the thing you have to understand is for most of the lenders, screener is not that useful. That is because in lenders we are not even looking at the numbers, right? We don't care about the numbers. What we actually care about is an analysis of what the management has done in bad times. So what we would really want to do is to understand how they dealt with COVID, what kind of stress they had in balance sheet. Then maybe we'll look at the first presentation that they have, because this was the closest to COVID. Try to see what, like, if at all we are able to figure out their GNPA, their stressed book, their restructured book in that period. Anyway, I mean, this would be, it's very difficult to just evaluate it like this. We'll have to go very, very, very deep for this. And to be honest, MFI itself being very cyclical kind of industry, for me it's a avoid right now. But if I had a if I had a ranking in avoid, these would all be -5. This would be like a -1, meaning I could study it if I'm like running out of things to study. We'll just do a few more. Let's do these three and then I think we'll just call it a day, because as you can imagine we can just keep going on and on, right? One company among these that is definitely worth studying. All of these are worth studying, I firmly believe. Vishnu Chemicals worth studying. Good Luck India worth studying, right? All of these are companies that are worth studying. They are interesting companies and I would urge everybody to go and study. As always, um, it is important to remember that nothing I ever mention is a buy or sell recommendation. I'm interested in all of these companies, including Good Luck where I'm invested. So I would strongly urge everybody to form their own opinions. I think if I remember correctly, EKI Energy is the one that did some kind of a they basically restated their revenues from past. Basically the auditor said you had restated or you had overestimated your revenue by like 20% and I think profit by 30%. So they had to like redo their previous financials, which is like it's a PAP, it's a sin in this world of investing, because it means whatever the company and the management say is, you cannot trust it, right? So this is like avoid in caps and bold it and make it red, minus infinity, right? Permanent avoid, because if you can if you can state your financials incorrectly, there's no point in studying you, because we can't figure anything out. Everything could be wrong. Share India Securities is an interesting company because, from what I understand, they're like a proprietary trading desk. They do a lot of F&O trading basically. Um, what you have to understand here is, what you are really valuing is the prowess of that company. I think they have their own algo trading desk also. So they do probably a bunch of algo and human discretionary kind of F&O trading. That is how they make their profits. Market is not willing to give a good multiple to it because they value it like a broker, right? They are not a broker, but they have a similar kind of drive, like the same thing is driving their revenues. So brokers make money because of F&O. That's probably how Share India Securities also makes money. I really want to see their website. I've never looked at it. Um, it looks like they might have a broking arm also. I think they have a broking arm also. Probably that makes some sense for them to be valued like a broker. But I think they have a proprietary trading desk also, and like that could be a big part of the profits. So let's just see the product segments. Share broking 85, wait, 989, and then NBFC 85, and technology 20. Okay, so I think that clears it up a lot more. Um, Probably the proprietary trading thing is also inside, but it's probably a broker also. Broker, the recipe to evaluate is very clear. We look for NSE active clients and the trend over time to see, like, are they gaining market share, losing market share, because basically broking is somewhat like a commodity. So unless you have proof that the company is gaining market share, it doesn't make sense to own it. But the drivers would be very similar to what are the drivers for Angel One, right? Same operating leverage and all of that. But I would put it at rank 4. Uh, I'm not that interested, simply because I know that Angel One is one of the top 3 and that they are gaining market share and they are undervalued. So the probability of success is just higher in Angel. Sorry, I'm just going to turn off my AC. It's getting a bit cold. Sorry. Let's go to PDS. PDS is another very interesting company that I'm watching very closely. PDS is essentially a platform for retailers to source things. So imagine if you are a retailer, you are Amazon, Walmart, or just a small company, a mom and pop retailer with like 20 stores in Chennai, right? Someone like a Saravana stores. You want to get apparels to sell to your customers. How do you get those apparels, right? How do you find the manufacturers? The interesting thing to remember, the mental model to remember for PDS is the same mental model that applies to something like an Uber, which is platforms work best. I would call it a platform if both the sides, the buyer and the seller, or the supplier and the producer, I mean the supplier and the buyer, both sides should be very fragmented, right? There are probably thousands or tens of thousands of retailers in the whole world. Of course, Walmart is large, but Walmart would not be more than 5% of the global retail, right? Similarly, Amazon is also huge, but if you ask Amazon, I'm sure if you look at their presentations, we'll figure out it's not more than 5 to 10% of the global retail market, right? It's an extremely fragmented market, retail. Similarly, on the production side, there are no large producers. They are mostly just mom and pop mills churning out garments, right? Most of them. Because of this, there is a need for a platform. But what you have to understand here is, unlike in the case of Uber, where there are transactional relationships in the case of a retail platform have to be more structural, based on trust for a long period of time, based on quality. The reason is, you would want to buy from them repeatedly over time. It's not transactional. You would want to have them as a supplier for a long period of time. And that is why it makes a lot of sense to have someone like PDS, because the human is needed in that, right? You can't make an app where like Walmart can just browse over producers in Bangladesh and then right swipe them. That doesn't work, right? You need feet on the ground, someone who visits the factory, someone who's on top of it. For example, if you look at PDS, their legal expenses are huge in other income. That is because in each of the subsidiaries, each of the factories, they would have a separate person that takes care of legal and compliance, right? That's how you make sure that the trust gets built up in the system. That's how you make sure that a garment that gets created in Egypt or Bangladesh meets the needs and the requirements and the compliance of a Walmart or an H&M or whoever they are selling to, right? Now the thing with PDS is they get a lot of revenue. They get a lot of revenue from UK, I think 47 or 50%. So essentially in the case of PDS, it is very likely that this is not a good time, right? You can tell from this, not a good time. You can tell it from the financials also, right? Last 1 year growth is 8%, profit growth is 7%. It has really slowed down, right? If you look at the latest quarter, 9% degrowth, 1% degrowth, 15% growth. Of course, there was pent up demand because of which earlier there was too much growth, right? Over time, you can see that they have done 17% growth and 65% profit growth, right? Now, the reason for the non-linear growth in PDS, because I've already studied it, is that they are incrementally going into higher value addition and the product mix is of high margin products, right? The way that they're doing this is earlier, if a garment is selling for 100 rupees, 100 would be their revenue, and then their gross margin would be like 10%, right? Because most of it is just raw material, you're just passing it on, right? Almost like a trader. What they are doing in the newer segments, if I remember correctly, they call it, so the older segment is called design-led sourcing, and the newer one is called, I think, sourcing as a service, right? SaaS. So what they are doing in the sourcing as a service segment is that they're only taking the gross margin of the previous part, which is like basically if it's 100 and your value addition is 10, they're taking 10 as gross margin, right? If you do that, then the profit margins would be much higher on that 10, right? It would be like 15-20% maybe net margin, net profit margin versus 3 to 4%. So what you can see is that basically it's a more of an accounting thing, but essentially they will move to higher margin products or services in this case, and so that's why the non-linear profit growth, right? I know all this because I've studied PDS and I'm just watching like a hawk their con calls. Of course, it depends on relative opportunities also. If Shivalik Bimetals becomes a 20 times earnings company, I might just buy that. I'm fairly concentrated. I only have like 11, 12 positions. And because of that, I just cannot own all the businesses I find attractive. Which is why just remember, nothing I ever say is a buy or sell recommendation. I can change my opinion at any point, primarily because there are so many opportunities all the time. Let's make this like the last company, Johnson Pumps, WPIL. 14 times earnings, I think they are very attractively valued. I mean, from the point of view of studying. Looks like they make turbines mostly. Pumps is what they make, and then project works, probably like EPC kind of work, is like half the revenue. And I'm guessing that from Jal Jeevan Mission and Amrut, in the government missions, they get a lot of orders. Right. Let's look at the revenues. Looks like it has slowed down a bit in the June quarter, and then June seasonally looks like uh, a bad quarter for them compared to like the March quarter, which is like the highest revenue. Um, I think it's worth shortlisting for me so that I can study it later on. Looks like they make similar kind of margins both in the product uh, pumps and the project work. Of course, the ROCs would be much higher in the project works because there is no capital required per se. It's just that you're taking extra margin for installing the pump, right? And that's like all very, very high ROC kind of business. You can see that the ROE has also expanded, profits margins have expanded. Let's look at the segments over time. I think unfortunately we don't have a lot of segment data here. Maybe we'll have to go to annual report and see. I wanted to see which of the two segments. You can see that the project work segment has expanded much faster. My guess is this would be higher margin product, net margin product, and that is why we are getting to a look at this, right? 26, 24. So it is indeed a higher margin product, and then even in pumps they have increased margins recently. So I mean it's probably a mixture of both value addition in each of the segments, and probably the segments also, like the higher ROC segment is expanding. Looks like it has good operating cash flow, so I will definitely add it to my to study list. WPIL shortlisted. I want to make it 2 actually. Then this becomes 5. This becomes 3. This becomes 4. I think, yeah, I want to end this video now. We are closing on like roughly 1 hour, but you can see that I mean, I did a lot of talking. If I didn't do it, I would probably have covered like maybe 50% more at least. So I've covered 13 companies in like 1 hour. I think I can do 20 in 1 hour if I'm not actually making a video. There are 66. I think 3 hours is a decent amount of time that one has to invest in order to go over all of these companies and then form an opinion on the ones that are worth going deeper into. You might remember Sarthak Metals as another company that I've talked about in other forums earlier. Foods and In is also an interesting company. Shilchar is an interesting company. All of these are companies I've studied uh, sort of to some varying degrees of depth. KP Energy is an EPC company for wind, so that is also an interesting company. SKM is, I think they make eggs, they export eggs. Kilburn is one of the companies that makes uh, process equipment like heat exchangers. They in fact did their first con call recently. Let's see. I'm just trying to see if I know. I think, yeah, Titan Biotech is a company that makes. I think they primarily make like the assays for transporting viral vector medium in uh, like sample collection for diagnostics. So I think a lot of these companies are very, very interesting, and I would urge people to study like all of them ideally. You don't get biased one way or another. Just go over all the 66. If you remember Warren Buffett, what he said is, start from the A's. So someone asked him, there are 10,000 listed companies. How do I go about studying them, right? He said, start from the A's, right? So in this case, there is only 66, right? Start from the A's. That's what we did. I think we went, I mean, we actually started from the market cap, but it just so happens the first few companies were A, from the A letter. But anyway, uh, happy weekend to all of you, and take care. Bye.